Hello everyone, today is April 18th. This is session number 4 of the Week of Trading course summer series. Next session is on April 25th. We're gonna go a little bit faster today through all of the announcements. The only thing that I want to kind of like briefly mention is that I've put you all guys on the list for WMD class, which is the Wednesday class at 3 p.m. The class that I teach together with Bruce. This is the last bar analysis class. And for those of you who joined yesterday, you kind of seen, what we do. Some of you already signed up for that class, and that's great. But you're gonna have opportunity also to attend session on the April 24th and May 1st. And then we're going to have a promotion, after that. So quite a few things that are coming your way. The second thing that I wanted to mention, and I wanted to thank John for stepping in and for doing the Wake Up Study group. So that was just, extremely experimental on our part. We kind of saw where it went. It went more into the Q&A, which I was kind of trying to avoid a little bit. So we'll try to refocus it on actual work. What I want you to do, guys, in the study group is not necessarily to ask the questions about the material that we study here. It's just too redundant. It means that, I'm saying something and, you might not be hearing what I'm saying. So the easiest way to do that, to find those questions, is just to re-listen to the recordings. So the next session will be all about practice. So we'll see how that's going to go. And we'll kind of, keep experimenting and trying to find the proper solution. So I have a couple of ideas in mind. Okay, so that's it for the administrative stuff. Today we have a lot of work, even though not a lot of time, so only 2 hours, as I mentioned. But I wanted to go through some of the Q&As, so keep sending those. If the question is relevant to the current discussion, I will put it on. There are quite a few questions, and I will make a point out of this today. A question like this. Well, what about supply? What about volume? What about price and volume? What about effort and the result? All right, guys, we'll get there. Actually, today we're gonna start talking about that, but, don't rush. I still see a lot of mistakes that are being made in the homeworks, and I kind of get an overall sense for the group. We still have to practice the structural analysis. Some of you are really good with that, and some of you require more work. So we need to go with kind of like the speed of the group. We're going to have 3 homeworks today. Now, one of them is going to be optional. So this homework 4.1 is an optional homework. It's on labeling Apple. So this homework most likely will be just self-reviewed. I'm just going to give you the solution slides, and then you will review your homework later on. We're going to do a little bit of the review of the Microsoft homework, just because there are a couple of points there that I want to make, maybe a couple of questions that I want to answer there. But again, this is more of a self-review. And by the way, whenever I see mistakes now in labeling in your homeworks, one of the things that I mention is go review my labeling and ask the questions of why is it labeled this way. And if you don't understand that question, that answer, go to the schematics and try to identify the same phase, the same event, read about what this event is, what kind of characteristics for these events we would be talking about. And that's the work that you need to do. So the easiest route, kind of like a lazy route that I see sometimes, is not to explore it this way, not to re-listen, not to go to the slides, not to figure it out, but rather come back to me and just ask, well, what about this? And we're definitely going to go through some of those questions, and I understand that we need to repeat, so we are constantly repetitive mode. But at the same time, make an effort, go to the slides, try to figure it out. All right. We're going to start on the new material today. So we're transitioning into the volume and price analysis. So we'll start talking about basics. So you guys are jumping a little bit ahead, like, you want to talk about more advanced concepts. Well, one of the things that I've learned by teaching this material is that the basics are the most important things for us to be engaged in, just because everything is going to be based on basics. So we need to understand the spread and the true range, the difference between those two. So we'll go through that today. Then we're going to talk about the VSA, volume and spread analysis, and we're going to look into the contextual interpretation of the VSA signal. There will be a homework on the VSA, on the volume and spread analysis. That homework is not optional. This is something that I would like you to do. And this is going to help you develop, a visual recognition of the volume and spread analysis concepts. Then we'll talk about the significant bar reversal. This is the concept that is not by Corfin by any means. It's just the concept of the reversal of the swing that I've developed for my own trading, and then I started teaching that, to students. Students usually very much like this concept. It's very simple, kind of like, have some details, nuances there, but simple overall. And we just need this concept for our next exercise, which is going to be a group exercise and a homework in one. And there we will be doing both. We will be talking about supply and demand, volume and price analysis, plus we also will talk about structure and to a certain degree tactics, because we'll talk about where the position should be opened, closed, and so on and so forth. And then an introduction on the supply and demand effort and the result laws. So we'll talk about that. So quite a plan today. We'll see where we're gonna stop. We'll probably maybe we'll end like at maybe like item number 7. And then obviously I would want you to look at the homework, the group exercise, and we'll just prepare for that for next class. Okay, Q&A. Let's go through this very quickly. Chris is asking, how do you determine your position when you followed Wyckoff, but then unexpectedly the price moves against you? So for instance, you're thinking that you are in phase C, and you open in the position somewhere here. Everything is by the rules. You might add to the position here. Again, everything is by the rules. You are expecting the price to go into a sign of strength rally, which it does. And then you're expecting the backing up action. The backing up action comes like this, and then it fails. So we would be exiting on the failure of the backing up action. So here is this kind of like question. If the price unexpectedly moves against you, then what are you going to do? Well, this is probably the best case scenario as to where you enter the position, the price moves against your buys that you had, and then you just close like this. And you might close with small win, you might close at break even, you might close at small loss. We don't mind that type of scenarios. We just want to make sure that we're not in a scenario where, we are being caught up in some kind of gap action, where it gaps, let's say, like minus 10%. So the biggest question for students here is, well, how do you avoid this? The only way to avoid this is to analyze better. There is really nothing else, unless you do some kind of hedge strategies, which we're not going to discuss in this class because it's a little bit more advanced of the material. So if there is a gap like this, this means that most likely, you've miscalculated your analytical approach, and you've selected the stock that had some kind of, distribution coming into it in a more meaningful capitulation type of way. So there was something prior to that that was underlooked. Well, what do we do if we make this mistake? Because we are humans, so we are prone to make mistakes. And plus, again, you gotta practice for quite some time to get to the level where maybe these situations are gonna be very limited in your trading. But if we do make this type of mistake, what do? Well, we need to assess, what is happening right here, but the first reaction is going to be if it, went through our stop loss, which we identified as the place of our own capitulation, then we should capitulate here and we should get out because we don't know if the price is going to continue going down or not. For more advanced students, identification of the current environment, like on the intraday level, probably would be helpful. Assess how the selling has happened, whether on the intraday there is some kind of bounce. Look at that intraday bounce and see if that bounce is going to fail or it has some kind of, strong momentum behind it. So again, those are going to be more advanced techniques that we are not going to discuss here. Next question. Volume at the moment seems less important than price movement. No and yes. No, because volume is important and we will start studying right now. Yes, because we were studying price structural analysis. And what I've noticed in my 10 years of teaching this material, or almost 10 years, is that we are being distracted by a lot of information. So whenever I want to discuss the structural analysis with students and we have volume on the chart, they are totally distracted by the volume signature and they are not thinking about the structure. So it's a very, very deliberate way of how we are giving this material to you right now without the volume signature so that your minds would not be contaminated with unnecessary information. Do you include large tails wicks when setting boundaries? Okay, so the question is more about how do we set, let's say, specific levels for the support and the resistance. We could do different ways, right? So we could do this, let's say this type of thing. We could do this. It just all depends. The art of, let's say, trend lines, which support and resistance are, is all about specific guidelines. Those are not necessarily rules, but they are guidelines. You have to pick up significant low to the next significant low, find the significant high in between, and then connect those points. But sometimes, indeed, you're going to have a tail here and there, and it's up to you to decide how exactly you're going to do this. In some instances, my preference is to use the open and closes because tails are usually extremes, and in some instances tails work okay. So I would say just experimentation, and kind of like figure out your own style. Next question from Erica. How can you tell that the demand is drying out? Do you look at the volume and price spread? Again, I just want to kind of make this point that you guys are running a little bit too fast. So make sure that we are kind of like, going with the group, right? Because if I would feel that we need to accelerate, we would. It's just I think that we have to be a little bit slower right now. Can the price travel down and up with no significant volume? What is the psychology behind it? Again, exactly the question that we will be addressing as part of the material. So everyone is kind of like a little bit, too fast, moving too fast. So, and I'm saying to you guys, slow down. Devote time and quality to the material that is now, not in the future. When do you denote upthrust action versus secondary test? When it moves temporarily above the trading range. when is the event called an upthrust versus upthrust action from Eric. And Eric, I'm not sure, if you had a chance to go through all of the material because we've talked about this, there was a slide on this. But, really quickly, let's just talk about this. First of all, an upthrust action or upthrust action like this is going to be an element of an accumulation or reaccumulation. And we would see, an usual upthrust, a temporary commitment above, and then a return back into the trading range. So in the accumulation, reaccumulation, this would be an upthrust action. In some instances, we might have a phase A secondary test as upthrust. This would mean that the price would overcome the resistance and then come back into the trading range. But it would do so in the upthrust type of manner. So we would say secondary test as an upthrust. Okay, in phase B, we might have also an upthrust action. So the price overcomes the resistance and then comes back. Upthrust is going to be always a function of the distribution or a redistribution. So therefore, in the distribution, we would label any types of upthrusts as UT rather than UA, and that's the main difference. Excuse me. Okay, so let's go through the homework for one. This is an optional homework. So for those of you who don't have time to do this, that's fine. Just concentrate on the primary homework. For those of you who have time, optional homework is going to be something what we've done before. This is just basically a repetition that we need to do over and over and again. We want to look at the structure. We want to look, and I'm giving you the volume signature here, although it doesn't really matter, but we'll extract some information from there. But don't pay a lot of attention to the volume. Pay more attention to the structure. So I want you to label this, show me all of the phases, show me all of the Wyckoff events, and also identify changes of character. So here is chart number 1, 2, and you kind of could see multiple trading ranges right here. 3, 4, 5, 6, 7, 8, 9, 10, 11. So 11 slides, so and you have multiple charts on some of those. So as you could see, quite extended homework. So again, for those of you, who do not have extra time for this, you don't have to do this. This is optional. You could also do this maybe like upon the completion of the course. You could come back to this homework, redo this homework, and then self-review it after you're done. Okay, so even though I've said that our Microsoft homework is going to be self-review, but there are some of the issues and matters that I want to attend to going through your homeworks today and just kind of like getting a sense of where we are. We definitely need to stop at some places. And right away, here is a question from Sean. It is stated that the secondary test in accumulation in phase B, testing the selling climax and secondary test. So testing the phase A. Okay. Would the second test in recognition be phase B, testing the low of the automatic reaction? It's a little bit hard to see here, so let me just take another color. Okay, so we have a secondary test, which is the test of the climactic action here. We have another series of tests, probably in phase B. We have another series of tests in phase B. We have another series of tests in phase C. So there are probably, if I understand here, maybe the question is like, okay, well, if this is phase test 2, this is test 3, then what? Yeah, we don't have that sequence of the tests, 1, 2, and 3. So let's kind of visualize this a little bit. So obviously this is the test, the local test to the climactic action. So it seems like this is phase A. Then look at the rally and how it happens. So we see that the rally to this high right here, if we would just look at the rally, this is just A, B, and C, right? So and within it, it has also 1, 2, 3 or ABC formation. So something like this, A, B, and C. So it seems like this is just one swing that has the tests um, in the middle of that swing that are probably still testing this area right here. And then more significant test of the previous lows is here, and then more significant test of the lows is here. So and you kind of could see how, I'm trying to almost kind of justify, the test area, and maybe I'm not explaining this in the correct way. Let me explain this in a slightly different way. If you look at the first reaction, the change of character reaction, the test, it has that, kind of like drop. So by itself, in the reaccumulation, the the automatic reaction, if we would label it like this, acts as test number 1. Then look for the second reaction of the same magnitude. Where is it? Is it here? Probably not. Not the same magnitude. Is it here? Probably not the same. Not of the same magnitude. But this looks like of the same magnitude. So therefore, this is our test number 2. This is the test of the previous reaction. Where is the next test of the same magnitude? Here. So this is the test of the previous 2 tests. And therefore, this is a test number 3. Now, test number 1 has its own local test. Phase B has secondary tests that are testing the rally, not necessarily, of that big magnitude test. And then test number 2 has its own structure, so there is a local test here. And test number 3 also has its own structure and local test of the reaction. So you kind of could see that you want to identify the tests as the tests of the same magnitude. And you kind of could see that 1, 2, and 3, and then local tests surrounding that. Okay, let's see how the labeling happens here, and let me see some questions. Simon is asking, when we're looking for a single test candle, we're looking for a swing low or a hammer looking like candle, or is it a series of candles? So it could be, when we're looking for the test, is this one candle or a series of candles? And this is where, obviously confusion might come. We are looking again, think conceptually, right? So we're looking for the testing action. This testing action, could it be 1 bar? Yes, for sure. Could it be multiple bars? Yes, for sure. Could it be a series of bars, like a trading range? Yes, all of those could be testing action. So you could have a bar like this that still tests the climactic action. You could have a series of bars, like a trading range, that still tests the previous action. And you can have just several bars that are testing, the previous low. So all of those possibilities are there. And that's why, we always say that it's really good for us to think in terms of concepts rather than in terms of the rules. Okay, so another kind of like confusing situation here. A lot of you have placed the buying climax right here and then extended the trading range throughout the whole formation. Do I have a problem with this? Probably not. Again, the trade that's going to happen on the right side of the trading range. So it shouldn't affect your profitability whatsoever. But at the same time, in terms of, concepts as to what do we see conceptually. Okay, well, we definitely see um, a huge change of character right here. And then we see a change of character here as well. And it seems to me that there is some kind of climactic run, so buying climax should be there. There is an excitement here as well, so this looks like a second point of excitement and definitely acts as an upthrust. And then we have, a movement akin to a downtrend movement where spread increases, gaps, volume increases, and so on and so forth. So it seems to me that this change of character is a much more pronounced change of character than anything that we've seen on this chart. So we probably should be assuming that this area right here has some kind of smaller distributional qualities to it, and it acts as a cause for the price going down. And this is where the price stops, establishes the bottom, and from there we start the labeling. Another confusing point here is in phase A and early phase B. You have the first rally up, which is the best rally on the way down, and that suggests to us that this is a change of character. And now, if it's confirmed by the secondary test, which it is confirmed, then it's going to become a complete structural change of character, which it does. You could also, in some instances, I see students put in automatic rally to this area right here. I would probably, even though I put it in here like this, I would probably label this as an upthrust action. Once the change of character is defined, is determined in phase A, everything else is going to be phase B. And we kind of could see that in phase B, the price does not want to go down. So those are the elements of phase B for the stocks that have a lot of institutional interest. Sometimes phase A is going to present an oversold condition for institutions. They're going to push the price up into the highs of the resistance in phase B, and then the price is going to stay there. Why is it staying there? Because the institutions just do not want to sell. Okay. Great. And then the last point here is phase C. So we've talked about the three tests, but also let's talk about second point of fear. So where is our first point of fear? Well, obviously in phase A. This is where the largest change of character has happened. Where is the second point of fear? Well, probably these two spreads that are increasing relative to the spreads in phase B reaction. And because of this increase of the supply, we definitely need some kind of retest. And this retest come here, and we could include the test into phase C. This was one of the things that was kind of like uniformal. A lot of you have put phase C as just identification of that second point of fear, which was great, but you forgot to think about the emergence of the supply on this second point of fear that would require the test and subsequently would become a part of phase C. Okay, great. Anything here? Probably not. So let's do the self-review of this slide. So just, as you do your homework, print out your slides or have them on your computer, iPad, and just print out my slides or just have them somewhere visually and, compare. Simon is asking, what is the methodology of drawing upslope and support and resistance line in real time? Here we connect support lines from phase A to phase C. Do we need to wait that long for the trading range to develop? Yeah, kind of surprising questions that I get from you guys on the upsloping and downsloping structures. Surprising why? Because we did talk about this, and I did have this slide on how we actually construct upslope and downslope and trading ranges. So I'm assuming we're just repeating at this point. What are the rules or the guidelines, let's say for the upslope and trading range? Indeed, we will take the significant low in phase A. We want to check what kind of lows we have in phase B, and if they are not on the same line, then we want to take a significant low in phase C. Now, those two lows kind of make sense to connect. Why? Because we have capitulation into phase C by general capitulation into phase A low, and then we have a weak hands capitulation into the low of phase C. So both represent emergence of the supply by weak hands, and both represent some kind of points of fear. So therefore, reactions are going to be usually of the same magnitude, and it's logical to connect those reactions. So this is what we would do. And then we would just project the parallel line from the automatic rally and from the upthrust action. And we could see how this cluster plays such an important role as a support in phase D for the backing up action. Now the question is, could we foresee that this range is going to develop earlier? Well, in this instance, no. But in some other instances, we can. And I'll show you where we will be able to project phase C. Because the main question that Simon is asking, maybe by not necessarily asking this, is could we find phase C using upslope or downslope? Because if we see the reversal on the upslope downslope support, that gives us an edge to come into the position at the correct timing. Why is it not possible in this case? Well, because we need at least 3 points to create the support and resistance lines. We need 2 significant highs, and before phase C, the significant highs are going to be these 2 highs, maybe this one right here. So we would be thinking about this slope. And then we need to project that from, let's say, an automatic rally. And if we do, we clearly see that this upthrust is not touching the resistance. So this slope, it would not work. So until we actually hit phase C here, and until this bar where the actual reversal happens, we wouldn't be able to define this line. But first of all, in other structures, we will be able to do this. That's number one. Secondly, even with this example, the key is going to be what happens next and whether those lines are going to work. And look at how they worked. We're defining the major sign of strength by the rally that commits above the resistance, that is upsloping the resistance, that is based on these 2 lows and the parallel line that we project from phases A and B. And then we know that the price is going to come exactly to the level of the support that acted before as the resistance, and it does exactly that. So therefore, that's valuable. This is, still would work out really well. A question, do you use reverse trend lines? Absolutely, yes. I just don't necessarily show them in a specific way. But the concept of the reverse trend lines is always there. I don't have to have the dotted line to show that this is a reverse line. Okay, and I'll show you, Simon, somewhere, where we do that. From Helen, why is the end of phase C before the upthrust is above resistance? Why the end? Which trading range, Helen? First of all. First. Okay, so actually, let me just unmute you for a second. Kind of felt that I wanted to hear you. Are you there? Helen, are you there? Do you have the mic? Okay, so no mic. Okay, so now you're saying second trading range. Okay, so let me come back. So the question is, why is the end of phase C? Okay, so right here, before the upthrust is above resistance. Okay, so before the upthrust. Okay, so this is the upthrust. And so I don't quite understand the question. Why is the end of phase C right here, right? So this is the end of phase C, is before the upthrust. Okay, so I'm not quite understand the meaning of this question, but let me talk about, how would we, let's say, define the boundary for phase C here. So think about phase C. What is the intention behind phase C? Helen, what is the intention behind phase C? Can you write it down really quick? Answer me this question. What is the intention behind phase C, Helen? Helen is saying spring above resistance. No, that's not the intention. What is the intention behind phase C, Helen? Helen. I'll wait for you, so just reply. Helen, the question is, what is the intention behind phase C? What do you think the intention behind phase C is? Okay, so I can't get this answer. Okay, anybody? Okay, Ellen is saying, take us out of the trading range. No, that's not the intention behind phase C. And this is where I kind of see that we have blind spots. This is the kind of, the spot where I'm telling you guys, you gotta study. Because if you don't study this material that I've given you and you come back to me and we talk about the concepts from the first class, second class, third class, and we kind of still there, we can't move forward. So the intention behind phase C, and a lot of you are saying here, is to test. This is the final test, right, of the levels of the supply at the level of the support. So in this instance, the boundaries for phase C are going to be determined where this, where this test starts and where this test ends. So this test starts at the level of where the price comes to the previous intermediate support and it starts testing this support. And that happens exactly at this level right here. So, I mean, obviously I'm not extremely precise with the boundaries, but conceptually we know that it's going to be somewhere here. This is where the price starts retesting the lows of the previous up move. So that's number one. Secondly, conducting the test further to the downside because there is another level here to test. There is another level here to test. So two levels were tested, 1 and 2. Coming back above the first level of the support is going to define the second boundary of phase C. And we've discussed this. This was on the slides. This is something, Ellen, that I want you to come back. Helen, I'm sorry, not Ellen. Helen, to come back to that slide and revisit. And if you feel like you still have some questions, go to the recording and go to that slide on the recording and listen in again. I think that would be extremely helpful, to do that type of work. And I kind of see this, from a few of you guys where, we went through the material and then there is still, the same question coming back and back and back. So I see that, some studies needs to be done. So that's why I'm calling up on you like this a little bit, and pushing you to study. Okay, great. What else is here? So nothing else is here. Okay. This was a very interesting chart. So I deliberately left out a lot of the things that I could have put in here. And a lot of you, the majority of you, did something correct, but something that, maybe did not give you understanding of the much larger structure. Let me ask you this question, guys. What if we bought the stock in this area right here? And let's say by the time that we're finishing, let's say all of this testing in the phase C that I here identified here, are we making any money? We're not, right? And then what does the price do? Kind of fluctuates around the mean of where we bought. There is nothing going on. So this whole thing is your trading range, and it's just a much, much bigger structure. And sometimes trading ranges are going to be that big. They're going to be that large, right? So this is 3 years or so with the sign of strength in the backing up action. And I wanted to show you this without all of those smaller trading ranges. This is where, you would spend a lot of time on that, and that's totally fine. All of that work is useful. But I want you to step back, to zoom out, and to recognize that there are the same elements in this larger structure as we study, in the regular trading range. We see the climactic run into the stopping action, buying climax. Then we see a change of character. Yes, it develops for a long time, but it is a change of character. So therefore, we would label this as an automatic reaction. A test that is testing the previous lows by the same character or somewhat close to the climactic character run rally. And that secondary test, we could say, secondary test is an upthrust action. Commitment to the upside and then return back into the trading range. Multiple tests of the highs in phase B, multiple tests at the low but in the middle of the range, which suggests some strength, and then a second point of fear. We've seen first point of fear on the change of character, second point of fear going into a potential phase C, and just because of how this reaction developed relative to the reaction number one, look at how much faster the price goes down. There are gaps to the downside, spread is increasing. So this is like much faster move to the downside than what we've had in phase A. So therefore, we are thinking that supply might have increased. If supply has increased, then we need some retesting. And retesting could come as a trading range, which we do have in this area. And then after that, as we are retesting it, as we are consuming, absorbing that supply that came on the reaction down, then we are rallying out of this position on the major sign of strength. And then look at how we're coming by the last backing up action here exactly to the area of the support. So just a very, very big structure that we could label like this. Now, having said all of this, now let's think about what you guys have done. So you identified smaller ranges like this: phase C, phase A, phase B, sign of weakness, LPSY, LPSY, upthrust. Is this correct labeling? Absolutely. You have your small textures, trading ranges, where the texture is the same. This is the same texture here. This is the same texture here and trading range on its own. This is different trading range, and you could just combine this whole thing into one. This is a different trading range, and then this is a different trading range. So you kind of could see how the swings are being created. A swing up, trading range, swing down, trading range, swing up, trading range, swing down, trading range, swing up, trading range, continuation to the upside. So you have a large structure on its own that you can label, and you have smaller substructures that create the causality for the moves in between the trading range itself. By the way, John is here. He had a talk at the Wyckoff Students Forum just recently, months ago, on substructures. So if you want to listen to him talking about this substructure, smaller substructures in a much larger trading range, go to our YouTube channel and find that video. It's going to be at the bottom, but very useful material right there. Okay, so how would you label all of these trading ranges? Okay, I'm just going to label phase C so that you guys kind of could see how we would label here. I would start labeling here with smaller trading range first, but then would extend it and would have phase C here, sign of weakness, upthrust, and then here, and this is a little bit more complicated because it's just so extended, so phase A, and then we have upthrust action in B, test in B, test in B, all of these elements of B. Then this move down, that's the beginning of C. Again, look at how the boundary, that question that Helen had about phase C, how would we define the boundary? This is the first time when these lows in phase B were tested. So think about phase C conceptually. What is it about, phase C? It's about testing of the supply, last test of the supply at the level of the support. We had test number 1, we had multiple tests in phase B, and now this is the beginning of the final test in phase C. And then the price, when it truly comes out, and it truly comes out right here. So this is where the boundary is going to be. So our boundary for this smaller range is going to be something like this. A, B, C, D. Something like that. And this would be the final test at the support level. This would be the final test number 4 as a backup action at the level of the resistance. Okay, so again, just want to say that all of you who have labeled, smaller ranges like this, you guys are absolutely correct. I just want you to have a slightly different perspective as well. Sometimes within the larger structure, you're going to have smaller structures. So you gotta see both. Okay, question here from Eric. At what point do you decide to draw an upsloping or downsloping trading range? Again, let's just walk through this, right? So we need 2 significant lows for accumulation or reaccumulation, and we need 1 significant high. Okay, so significant high, significant low, significant high, significant low. So I would say that somewhere here, you could start projecting based on the low, but you had a high here that was useful and was confirmed by this high right here. So once you see that confirmation even on the resistance level, you could say, okay, yes, I could use that reverse trend lines. and I could base everything on the resistance rather than the support. So you have two significant highs and one significant low here. So you put the line at the significant highs, project it off the significant low, and look at where it takes us. It takes us exactly into the spring situation in phase C. Now here we would have to assume that off this support we're going to have some kind of move up. But if you're going to buy here, you're going to be extremely inefficient because for maybe like 9 months, you will be in this trading range at slightly higher price, but in the trading range. There will be nothing going on, so your money is going to be parked and not produce any type of return before it starts moving out. And it's all in the supply signature that comes on the reaction. Okay, so I think we have addressed this. Okay, this one. The only thing here that I want to mention is that at that time, and this is a very legitimate question that you guys are asking, at that time we might be thinking that this is phase C. It looks like a spring, the price goes down, then recovers, there is some kind of test. We might be buyers right here. Let's say somewhere in this area. Okay, so what do we do? First of all, what do we expect for the price to do after we enter this position? Well, we want a commitment above the points of the resistance, right? So we have one commitment above, and we're not touching the buying climax here, and we're not overcoming the upslope in resistance. We're just coming to that and reversing almost instantly. So this is an element of an upthrust. So instead of a sign of strength, we came into the situation of the upthrust. And the earlier we recognize it, the better for us because we want to get out of this position. So we probably would be thinking that this bar right here would act as a failure, this bar for sure, and then something here. So this could be our trade here. So it's going to be either a small win, break even, or even a small loss, and we would be done with this position. We would start initiating this position again on the same premise somewhere here in the beginning of 1996, where we do have the spring and the test situation again. And we would be thinking this time the price is not making a lower low, so it's a strength on its own. It just had one sell-in bar below the local support, and then the price came back and retested and came back again. So this is a very bullish action on its own, but was repeated here as well. So the analog works. It's just a little bit better structural place for us after the strength. And then we would enter here, then we could enter on the way up before the point of the resistance. Major sign of strength has that commitment that we didn't have on the attempt to upthrust, and then the price comes back exactly to the level of the support which acted before as the upslope in resistance. So that's how the behavior changes and then the structure changes. And once the structure has changed, then we know that from the downsloping non-trading environment, we're going to go into the uptrend. Okay, and then also there was a question about, at what time do we decide that the downslope would work? So look at this. In this case, it worked early, pretty much, really well. So we have 3 lows here that actually 4 lows, even 5 lows. So this is just an oversold. And then look at how phase C is just going exactly where we want it to go. Then if you were not sure about that downsloping line, look at how this high was caught by all of these 4 significant or 5 significant lows. So this high confirms this downslope. Another way of thinking about confirming the downslope, just use the linear regression channel. and put it on like this, and you will see it right away because the linear regression channel will define where the mean is, and all of the price fluctuation is going to be around that mean. And until the sign of strength, that slope is going to be correct based on the lows and based on the highs, based on the mean. So I would use that for sure. Okay. All right, the same situation here with that upthrust action. So we kind of seen maybe a potential phase C here. The duration of phase B maybe, gives us an indication that, phase C is there. Some volatility that comes also could trigger the trade there. Again, our strategy here is if we're entering the position is going to be such that we enter the position after the test, and then we close this position on the failure somewhere here. So again, this might be a break-even trade, but the same type of conditions where we see a low, and then the price recovers and tests back exactly to this level, still within the trading range. And let's say if we're initiating this position, this will take us out, and we will find other places to add to the position as we observe what we observe different characteristics on this rally relative to the characteristics of the rally that preceded it. We see how the spread increases, the volume increases, the momentum increases, and how there is an ease of movement with which the price moves, throughout this formation. Okay. All right, so this also was somewhat interesting because in first case in 98, we see an attempt to spring or to shake out, and then on the downslope in range, the price commits above and then goes to the support. So everything is kind of classical there. And then for the distribution, the biggest confusion for me personally is just this area right here. This is obviously the largest reaction, so it's different. There is a change of behavior as to how the reaction happens. On the previous reactions, we see selling and then buying, selling and then buying, selling, buying. Here we kind of see selling, 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 and then we have even more selling. So therefore, we would be assuming that there should be a major sign of weakness. But I put here a minor sign of weakness just because it didn't commit below the support level, even though it seems that the slope works really, really nicely. It catches a lot of those lows. Look at how all of those lows and highs were caught in the slope. So we can't really deny it. But there is no commitment, so minor sign of weakness. And then after the minor sign of weakness, such a big move to the resistance. So it doesn't look like a major sign of weakness. I would probably put a major sign of weakness somewhere here. I don't know why I didn't. Maybe another LPSY, something like that. So again, Microsoft, think about the Microsoft going into 99, 2000, a leadership stock. How would the leadership stock be distributed? Higher highs, higher lows. That's the pattern that still would attract institutional participation, and those institutions are going to be weak hands. Last point of excitement, second point of excitement. What was the first one? Going into the climactic action by itself. Second point of excitement, going into the upthrust, and then selling off the highs. Kind of like a typical distribution for the leadership. Okay, let's see what kind of questions we have. Oh, actually, we're not done, right? Okay, let's just, let me see. Simon is asking, at the top of the trading range, secondary test, is this the test of the supply or is this the test of the demand? So in a way, we always, and this is such a good question, Simon, so thank you. In a way, we always test both, even at the resistance and at the support. We test supply going into the support because we want to understand if there is an increase of the supply, by how much, and what kind of result could that produce. At the same time, we want to test the emergence of the demand as well. Why? Because we want to basically say, is there any demand at this support level? So in a way, we do both, but usually we would just say that, okay, on the reaction, we want to predominantly see what kind of supply we have. On the rally, we want to, see what kind of demand we're going to have. But it's at the areas of the resistance where we're going to say that demand became poor and supply has emerged, and therefore reversal has happened. So from that perspective, both would need to be assessed. Okay. Okay. On this chart, when reading this chart in real time, would the automatic rally be denoted as a swing low between the buying climax and automatic reaction? Right here, this one. Yeah, you probably can. Previous low, this one right here. Okay, where? This one, right here. Yes. So could we put what, a secondary test? Is that what you're saying? Secondary test? Oh, automatic rally. Okay, reaction. Yeah, you probably can. Now, the only thing here to think about is think in terms of the swings, right? So for instance, this bar to the downside, to this low, and then the rally. Does this rally overcome this last commitment to the downside? No, it doesn't. So your whole swing is actually this. Kind of the same situation here. So here is that last bar that commits to the downside. Do we commit above it? We only have a tail here, so there is no true commitment. So therefore, this is the whole swing. So you want to define this swing, the whole swing, rather than just like a small movement to the upside and then to the downside. Having said this, think about this. If you label it like this, and then this is phase A, so you're basically going to do this. For quite some time, this will work because you're basically going to say, this is an oversold, this is an overbought, this is an overbought. But majority of the time, the price is going to be contained between the support and the resistance. So therefore, you will be okay here for a while, and it wouldn't influence your trading on the right side. But again, I want you to think in terms of the swings, right? So here is a swing, here is a swing, here is a swing, 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 swing. So something like this. So therefore, your automatic reaction probably is going to come somewhere here. So how do we know when the swing is exhausted? So the correct question would be, Simon, how do we know when the swing is reversed, right? So, and today, hopefully, we'll jump into that material and I'll explain how we look at the swing reversal. Okay, I think this is probably the last slide, right? So here again, a lot of you are going into a smaller picture, and you guys are identifying this as a potential phase C in the downtrend, kind of like a distributional phase C. So this is probably the only major mistake, well, two major mistakes. So thinking that this is phase C, and at the time you still can because it will produce a really good trade. But I've already given you the information of what has happened after, right? So the price recovered, went up. So, and then you already see, and you should be seeing how the price commits at the bottom of the trading range at the support. There is not a lot of progress to the downside as we would have seen in a sign of weakness. And you already know the bias to the upside. So you know this whole thing is accumulation. It's not a distribution. So therefore, you should be thinking in terms of how do we label the, I forgot to put the boundary right here. How do we label this trading range as an accumulation? So phase C is going to come as the final test. We have multiple tests in phase B. We have a test in phase A. So all of those tests are doing exactly at the level of the support of what we've discussed. It's testing the levels of the supply at the support level. And then after that, as we go up into the minus sign of strength, then into the LPS, last point of support trading range, finally committing to the upside, a small backing up action, and then off we go, continuing to the upside. Now, one of the things that I want to mention here, the second mistake is that again, we are not looking at the large picture. And even though it looks preposterous that the price would consolidate in this structure for over a decade, but sometimes that's what stocks do. And think about Microsoft here. What is the story? Well, Bill Gates steps down, right? Walmart takes control as the CEO, and nothing is being done in a major way, as I understand the history of the company. And that is being reflected in the price. Institutions are unwilling to put the money into this stock. And until the new CEO comes and that announcement comes, then we, don't see anything constructive. And then once the new person comes and the new manager comes, that changes uh, the company in the sense of where the policy is and how the revenue is going to be created out of that policy. And then the behavior of institutions changes. They come in and they start buying on this rally right here. And that creates the new structure. So therefore, a lot of you were doing like smaller trading ranges like right here, and those are all great. Those are all obviously, useful, and we should be doing those. But I also want you to see a large structure, so that's why I kind of put it as a big large structure. And the last point, coming back to Helen's question about how do we put the boundaries, how do we define the boundaries of phase C? Again, the intention behind phase C is to test. What are we testing? Previous levels. So here is that previous level in phase B. Once we go into the touch and therefore a test of that level, this is where we're going to put the boundary. On the way back, as we come back to the same level and the price overcomes this level, this is where the boundary is going to be. For the phase D, we want to include the sign of strength and all of the reactions until the point of the reversal out of the backing up action and the breakout. Phase A, we want to identify secondary test and the reversal out of that test, and that would be the boundary. And that's how we, would define those boundaries. Again, I've shown you guys the slide, so you should have that. Okay, let's see how much time we have left. So 50 minutes. Okay, that's cool. Let's go into the new material. Let's talk about the volume and spread analysis. So we're jumping into the new series on volume and price. There are quite a few things that we would need to discuss under the volume and price, and probably I should have a slide just on that. So what would we be discussing? volume and spread analysis is all about exactly that. We look at the volume signature and we look at the spread of the bar on that. And from that, we find some kind of signal. It tells us about the relationship between the price and volume, between the effort and the result. Secondly, um, we could extend this VSA analysis to a swing. So we would call this a swing volume analysis. This is where we would assess what kind of volume signature a specific swing has, and we would compare that signature with other swings, either, like upswing to the upswing or downswing to the downswing. We also would be talking about the volume phase analysis. So as we've studied phase analysis, and that is, phase A as a change of character coming in into the trading range, phase B as the war between the supply and demand that creates, the phase that creates the causality, phase C, the final testing action at the levels of the support, phase D, the initial markup of the price through the trading range. As we study those phases, we recognize that the supply signature in accumulation or distribution for those phases could have, the same type of signature. And the demand signature might, have the same characteristics, from one trading range to another. So we want to study those, and we will, and we'll talk about this more as we go along. Excuse me, guys. Feeling like sometimes I'm just losing my voice. Okay, so those are the three main topics that we will discuss, but we also will have a lot of case studies on volume signatures. And we'll discuss specific situations like the test of the supply, the absorption of the supply, horizontal absorption, vertical absorption, and so on and so forth. So there will be quite a few informational pieces that I'm going to give you on the volume and spread. And then we are going to do a group exercise. And this is the exercise that I expect a lot of you, especially those of you who said, okay, well, push me, one of the things that I want you guys to do is to step up and, do the analysis live and receive the live feedback from me. So in other words, we're going to go through the exercise together. I'm going to be asking you questions and, we'll do the analysis together. Okay. Well, let's jump into this. All right, so let's look at the bullish spread and the true range. And when we talk about the spread, we usually talk about the difference between the high and the low of the bar. And it doesn't really matter, for the spread, whether there is a gap or not. We could call this a daily spread if we look at the daily chart, or weekly spread if we look at the weekly chart. And all you have to remember about the spread is that that's the difference between the low and the high. Now, in some instances, we are going to have the gap. The gap is going to be produced by the overnight action, the buying and selling between institutions
Usually, that gap action is gonna overnight gap action is gonna occur on some kind of news, on some kind of announcement. So earnings is one of them. And for instance, if the company announces earnings reports after the close, that will increase the volatility in the overnight session, and a lot of institutions will exchange shares. So that would drive the price up or down. In this case, it's a gap up. And then in the morning, because the price is already higher, this is what the rest of the market will see, that all opening with the gap. So again, I want you to think conceptually here. From the previous day's close, did the trading happen here in the gap area? And the answer to that is yes. It just didn't happen in the regular market environment. It happened after the hours between institutions. But the trading has happened there. That's what drove the price up. So therefore, um, on the top of the spread for that day, which is the difference between the high and the low, we're going to add also the area of the gap, starting with the close of the previous bar, and that would become our true range. So that would give us a much better visual as to what is the actual result on this overnight and day sessions. And we could think of it as just one bar, and we would refer to as a true range. Let's look at the bearish spread in the true range. Works the same way. The spread, the daily, weekly, 5 minute spread is going to be the difference between the high and the low, regardless of how the bar looks like. You know, either to the upside, to the downside, either with the tail or no tail, either with the gap or no gap. The true, the spread is always going to be the difference between the high and the low. The true range is going to be again based on the overnight session gap where institutions have traded, and that's why the price opens up with the gap. And therefore, we want to understand the result of this bar as the result of both overnight action and the daily spread. So we would combine them, and that would define a true range. Okay, question from Chris. Are we able to trade outside in the outside hours? Yes, you actually can, Chris. Some of the brokers allow you to trade, if not 24/7, then 24/5 for sure. Now, the problem with that is that um, there is so much volatility in the overnight session if there is some kind of earnings report. And you don't want to necessarily be caught up in that volatility because sometimes volatility is so big that it could hit your stop losses that you've identified during the day and you left them there. And if you're kind of like seeing how the price moves through them, you know, by the end of the overnight session, the price might be away from your stop loss. But because, you know, you're trading during that volatile session, you might incline, you know, to exit the position. So there are some, you know, pros and cons about trading. My suggestion usually is not to do that unless you are at a very advanced level and you know understand how institutions could push the price really quickly up and down. So my suggestion is just to use the daily data and to trade off the regular hours. Is the gap definition different between the bullish and bearish example here? Isn't it the gap from the close? Uh, so from the close to the high. That's the true range. And then from the close to the low. Yeah, so should be correct. Okay, so another question. I'm sorry, guys. I'm kind of losing my voice, so that's why I'm recording. Are you calling the week a close from close, a week, the week a close from close to the low? Okay, so the week or tail are the same thing, right? So it's this portion of the bar, of the candlestick bar, this portion of the candlestick bar. This is the close, this is the open. So we would be thinking about not the low here or the high of the previous day. We only would be thinking about the close. That's the progression of the price movement in the overnight session. It starts from the close, not from the low, from the close and into this whole space actually goes into the open here. And then the price tries to rally and then goes down. So the true range will always be determined from the previous close to the high in the bullish case and to the low in the bearish case. Okay, well, let's move on from this. Okay, let's talk about the volume and spread analysis. And one of the things that I always reiterate when we start talking about VSA is you have to interpret the VSA signals using the price structural context. Because in a lot of cases, when I see the analysis by students and they say, okay, well, I see this bar, the spread is diminishing, and the volume is diminishing as well. This means that the demand is going down, and we're waiting for the reversal. Depending on where this type of signal occurs in the structure, you could have different interpretations. And that's why it's so frustrating to people that study the VSA and then they don't apply contextual interpretation and their results are so bad. Because that definitely would create that frustration in me if I'm using something and the results are not, consistent. So therefore, context is going to be the king here. This is the slide that I've used for multiple years. This is the slide that was created by a long time by Coffin, actually a doctor, Jerry Blythe. Jerry Blythe was a student of Hank Pruden decades and decades ago. And when he was studying Wyckoff method, the spread analysis was still not fully developed. Actually, if the one of the names in Wyckoff methodology that has developed um, the VSA approach was Tom Williams. Tom Williams actually has the book. It's not necessarily considered like the best of the books for volume and spread analysis, but you definitely, for those of you who are consider themselves more advanced and even intermediate students, yeah, I would definitely advise it for you to have this book in your library of Wyckoff books and to read it. Tom Williams actually passed away, I think a year and a half before Hank. So we had one loss in the community after another. Definitely losing my voice. Okay, so what did Jerry, indicates to us here? Well, first of all, just the general considerations, on the spread and on the volume. If the spread is increasing, there is little resistance for the price to move. If the spread is decreasing, there is some resistance, and if the spread is average, it just expresses the normal progression of the price. And then for the volume, usually the volume increase would be associated with the force of power, or we would say the effort increasing or effort decreasing. So effort by itself is a difference in volume reading from, let's say, one get there for, let's say, x1 and x2. Two different data points, and we want to see the difference in volume. And that's going to be our effort. So it's that, is there an increase in effort? And if there is an increase in effort, then how does that increase in effort, is being reflected in the price? Is the price moving in the direction of that effort? So in other words, as an example, if from one volume bar to the next we see that the volume has increased and suggested that supply has increased, we want to understand how the price reacted to this. Did the price stopped instead? And that would be an indication that demand is there. Or is the price moved in the downtrend and committed further down below? That would be a synchronicity between the increase in effort, between the increase in selling, and what that increase in selling actually does to the price. Increase in volume signature usually increases the force, evidence of imminent change of the supply and demand, and that's why supply is so important. So in a lot of cases, I will tell you guys that I've wanted to concentrate on the supply first and then demand, because supply is so important. Heavy volume signature usually would indicate supply, and therefore we would have to go through the process of absorption. And we would need to identify successful tests. Massive volume signature would identify climactic action, usually it would be associated with stopping action, but not necessarily just that. In some instances, it could be associated with some event, like earnings events, and so on and so forth. So there are quite a few variations on that. Decrease in volume signature usually tells us that the force is lessening, the effort is lessening. So therefore, again, we should be expecting something. Okay, well, this is a little bit, hard to visualize. So what I've done for you guys are just examples of this spread and volume relationship, and also examples of interpretations based on the context of where this signal happens. So the context here is defined on this slide by the advancing market. So let's just go through this. So we are in the uptrend. What is the spread doing? The spread is increasing. What is the volume signature doing? The volume signature is increasing. Think about this for a second. We are talking about advancing market. So we are in the situation where there is an uptrend. That's the context of this signal. This signal is on the increased effort, we have an increased result. Is this a bullish activity or a bearish activity? Obviously a bullish activity. We're increasing effort, and with that increased in effort, the price moves more. So bullish activity is confirmed. And we would have this also depicted in the volume equation, where we would say that the volume is increasing, so therefore, with the way how the result unfolds, we know that the demand is increasing and it influences that result. And we know that on that increase of the demand, demand is most likely absorbing the supply, so supply is decreasing. So that decrease of the supply by itself is a bullish indication. So, and this is like the most common supply and demand relationship, effort and the result relationship, volume and the price relationship. Okay, next situation. We are still in the uptrend. Now the spread is decreasing, but yet the volume is still increasing. So what is happening? Well, supply is increasing, and supply suggests that there is an attempt to stop the price from moving further up. So therefore, short term, we're expecting that there might be some kind of reaction. That's scenario number one. And then the second scenario is that we might have some kind of absorption at the higher level. Scenario number two. So both scenarios are going to be appropriate in this case to think about. Supply emerges. And again, one of the mistakes that I see that we do is once we, no, excuse me. Oh, I'm happy that it's only 2 hours today that I have. Yeah, I'm definitely kind of like losing my voice here today, guys, so I apologize for all of these interruptions. One of the mistakes that I see is that we learn how to identify the emergence of the supply. We could see that from the volume signature. The volume signature increases a lot and then there is no result. So we know that there is an opposite force to the uptrend force that comes in and produces a stop in action. So what is actually increasing? Demand could increase as well, but supply could increase. And it's so different from the previous example where supply is not increasing, it's actually decreasing. So that increase of the supply will suggest that there should be some kind of testing action that could either lead to absorption or that could lead to a reaction. And that's the mistake that students make. They only think about the reaction in this scenario, which is not covering the other half of what could happen. Absorption could happen here. So emergence of the supply is a suggestion for a test. And then throughout the test, we want to see is the supply being absorbed or not? So I want to kind of reiterate that. Okay, next scenario. We are in the uptrend. We are in the diminishing, decreasing spread, and the volume decreases as well. And we are saying that we are vulnerable to a reaction. Why? Well, usually in this type of the situation where the volume signature goes down, we usually would suspect that the effort to push the price up goes down as well. So therefore, as the demand deteriorates and becoming poor, we are naturally expecting a reaction to happen. And supply could have multiple, signatures there. Supply might be slightly increasing. It might be equal to the previous bar supply, or it might be decreasing as well. And in a lot of cases, you will see that decrease of both demand and supply. And because demand was driving the price up, and then it started to become poor, this is where vulnerability is going to come. Only because the buyers are no longer have a strong hand, we might have some kind of reaction, even if supply is decreasing. Next situation, number 3. We're still in the uptrend. The spread is increasing, like in the first case, and the volume is decreasing. So what is happening here? In this case, as the volume signature goes down, we understand that both demand and supply are going down. And yet, on both of the diminishing signatures, we see that the result is actually quite favorable. So on the decreased effort, we have an increased result where the price commits to the upside, where the price shows the increase in the spread itself, and where maybe the new commitment is based uh, is being done, above the previous resistance level. So there is an ease of movement with which the price moves and commits to the upside. And that's how the ease of movement is happening. It's with the commitment in the direction of the bias on the diminishing effort signature. This is how we would view, and this is how we would see the ease of movement. Okay, next one. We're still in the uptrend. The spread is increasing and the volume is increasing a lot. In fact, massively. And we kind of see that from the volume signature. So imagine that this is kind of like a regular volume signature that we've seen before. And then we see a volume spike. And a lot of you have asked me this question already. Well, what about the volume spikes? What do they mean? How could we interpret them? They are so confusing. What in obviously different situations for the volume spike, we are showing you here one of the situations where the spread actually increases and we have this massive volume spike. Well, whenever we have that massive volume, we always think about massive effort. And usually that type of volume signature would occur after some kind of event. So earnings again, would be that type of the event. Whenever we have massive volume, we would always say that on that volume signature, we are going to have an increase in the demand. So we're acknowledging the directional bias here, but we're also going to have the presence of the supply. And that presence of the supply is going to be significant. It's not going to be the presence of the supply that we've had in the previous instances that suggests some kind of reaction. This is going to be a much more significant in the way of how quickly the price might be stopped and then what kind of reaction we're going to have. Because of that massive emergence of the supply, it suggests that big institutional hands are selling, and that's definitely something of a concern to us. Okay, well, let's look at the different context. What about a downtrend, a declining market? And we're going to discuss the same situations. In the downtrend, on the increasing spread and increasing volume signature, we would be thinking that everything is normal for the downtrend. The supply is increasing, so the effort to the downside is increasing. And the result follows. So therefore, we are going to continue with that bullish and we're still going to be bearish. In this situation, usually demand will be decreasing, and it happens because institutions are selling. Why is the volume signature increases? Because institutions are selling, and who are they selling into? They're selling into weak hands. So therefore, institutional demand decreases, and demand decreases in general, whereas weak hands demand might be increasing, but it's not significant, so we will not see that in the demand increase signature. Okay, next one. Downtrend, decrease in spread, and increase in volume signature. So that still suggests that supply is probably increasing, but so is demand. And supply is dominating at this point the demand because the price is making the new commitment to the downside. But yet, with that increased effort to push the price down, the result is actually negative. The result is not as much as on the previous bar. So therefore, we're assuming that some demand increase is going on, and this could absorb the supply, stop the price from going further down, and not only that, it could actually reverse the swing to the downside and produce that reversal and swing to the upside. So we would be thinking at this point that demand might attempt to stop the downtrend and reverse it. Next one, downtrend, decreasing spread as in the previous scenario, and then the volume is also decreasing. With this decrease in the volume signature, we have a suggestion here that supply is decreasing. And again, demand here could have different variations. Demand could decrease with the supply. Demand could stay the same from the previous bar, or it could slightly even increase. And in all of those cases, it's the decrease of the supply, decrease of the primary force behind the current swing to the downside is going to suggest, uh, exhaustion for the decline, and would suggest that this decline is vulnerable to a rally. So therefore, short-term bullish. Next one, we're still in a downtrend. Spread is increasing. Volume now is decreasing. So we had decrease in volume signature on the smaller spread. Now we're seeing the decrease in the volume signature for the big increase in spread. And that would suggest that supply is decreasing and demand is decreasing as well. And with the way how on the decreased effort we have a positive result, we would be thinking about the ease of movement. That's how the price moves without any resistance of the demand to stop the decline and reverse the decline. So if the demand is poor, supply could decrease and still we could push the price down and commit to the downside. So a very bearish activity in the declining market. Last one is a massive volume signature, and usually we would see those around climactic actions, stopping actions. This is where the volume signature is going to increase so much, and we'll be talking about the volume spikes. Within the direction of the bias, we're going to say that supply still dominates the demand and pushes the price down. But we already know from the volume spike that the demand is there. Someone from the institutional camp is seeing the value proposition, and it's also very liquid in terms of how much shares are being exchanged and available for sale and for buying at this point of time. So they would be attracted to both the value and the liquidity at this spot. So effort is increasing tremendously, result is increasing as well. And because of the increase of the demand signature, we might be expecting some kind of short-term stop in action and possibly reversal that could bring us to the short-term bullish bias. Okay, guys. Well, hopefully this is useful, in terms of visualizing all of those concepts. Let's see if we have some kind of questions, comments here. Is this analysis always with reference to the previous candle in context? Or you could not make this analysis on just a single candle. You could do it, Simon, you could do actually both, right? So you could have a candle and you could say, I see that the spread is increasing and the volume is increasing. So you could extract a deduction just out of that alone. You could say that this is a healthy downward progress on the increase in supply signature. You could compare it, a bar to the previous bar, and that would be a valuable comparison because we always want to um, understand how the conditions are changing and how do we extract this information. We need to understand what's happening now relative to what has happened prior to that. And the most recent action is going to be the most recent bar, a bar prior to the bar under observation. So therefore, we would be comparing one bar to another. Having said this, the context could be defined in so many ways. And I will teach you as we go through this group exercise how to think contextually in terms of the whole structure and how to think contextually in terms of the specific bars that we could identify at different structural spots and compare to each other. For instance, we might be comparing one big expanding bar on a huge signature to the bar maybe on the next or prior reaction that might be having the same type of bar but diminishing volume signature. And we're going to call these two bars analogs or analog bars or analogous bars. And we would compare them. So you indeed have, those three different ways of how you could think about the volume and price and how you compare, those bars. Good question. Okay, one more. Could you explain the ease of movement scenario again, please? I thought effort and the result need to be in harmony for price to move. Wyckoff third law from the memory. Okay, so three laws that we have in Wyckoff methodology is the law of the supply and demand, the law of effort versus result, and the law of cause and effect. So those are the three laws that we have. The other law that you're talking about is something that I mention sometimes, as a law, but, obviously it's not the law. It's more of a kind of like a guideline. And I call it the synchronicity. So what is the synchronicity? Synchronicity, and we'll talk about this more, is a moment when the change in effort produce the same change in the result in the direction of the buyers. So for instance, if supply is increasing and the price goes down, that's a synchronization between the increase in effort and the way how that increase in effort is being portrayed on the price itself. So therefore, if the price increases in the direction of the downtrend, with the spread, with how the distance of the reactions increase, then we know that all of the increased effort produces result and there is synchronicity. It's when there is no synchronicity, then there is a change of behavior. It's when there is a synchronicity between the effort and the result, that's when we also could first in the uptrend or downtrend observe the emergence of that new bias. So therefore, coming back to the ease of movement, it becomes a little bit of the counterintuitive concept because we don't have both increase of effort and increase of the result. In this case, we have a diminishing effort signature and increasing result signature. But the way of how we will think about this is we'll think that the opposite force to the force of the bias, right? In this case, we have a declining market, and we say that supply is decreasing. So supply is still dominant force here because it drives the reaction down. But because the demand is decreasing, that suggests that um, we don't necessarily need to think about the decrease of the supply as a bad thing. The demand is poor, so it has no strength to stop the movement uh, down or to reverse the price from right now. Poor demand is gonna have attempts to rally, and all of those attempts are gonna fail until a true institutional strong demand is gonna come and is gonna indeed observe the supply and reverse the swing to the downside in a decisive manner. So with that poor demand, diminishing demand, um, no matter how much supply we have here, result is still being produced, and that's the most important thing. So therefore, an ease of movement on diminishing supply signature and poor demand. We will talk about this more, Simon. So no worries. I'll show you multiple examples of this price volume action, and it's a tricky one, but it's nothing that cannot be systematized and then kind of absorbed as a point of knowledge and then be recognized even on the live chart as it happens. Okay, great. Let's see where we are. 10 to 5. Okay, we're gonna do this. So we're gonna skip a significant bar just because we're gonna come back to this next time. Okay, let me just see. So the homework. So this is the homework that I want you guys to do. I want you to take all of these scenarios and visualize all of these concepts on any of the chart. So take, for instance, an Apple chart, Microsoft chart, whatever you want, and then find all of these scenarios. There are 10 of them, right? Going through the advancing market, 5 scenarios, and then going through the declining market, another 5 scenarios. And then I want you to visualize all of these concepts, on any of the stocks, on any of the charts, and then send that to me. Okay, we're gonna come back to this later on as well. Supply and demand thing, that's gonna take a while. Okay, group exercise. So this is another homework, and this is gonna be a homework where I would like you to conduct your analysis of the chart that I'm gonna give you, and I want you to think about the supply and demand and the price and volume relationship, effort versus result. You want to label the trading ranges as well with the phases and with Wyckoff events, and we're gonna do this in a specific way. So here is our slide number 1 for this exercise. And as you can see, a lot of the bars have numbers, and then we also have the numbers for swings, right? So here are the swings that we look at. So you have 12 swings and you have 37 bars that I want you to think about, or I want you to analyze and discuss in the next class. And the way how I want you to analyze the bars is going through the bar analysis, going through the analysis of effort versus result. And this first step that we're making here, regarding this exercise, is going to be something there that is going to be based on the knowledge that you have right now about volume and price. So just do your best and try to analyze, at least, the first 25 bars. If you can, you can analyze everything up to this bar number 37. But once you go through this, and in the next class, we're going to start talking more about effort and the result, and we're going to bring more definitions, and we'll start talking about the volume phase analysis and so on and so forth. It will start making a lot of sense. And we'll combine the price structural analysis as well into this picture. But we have to start somewhere. So I want you to think about the volume that each bar has. And specifically think about the demand and the supply on that bar. You know, what kind of difference in the effort each bar has. What is the dominating effort, supply or demand? And then think about the result. What is spread doing? What is the close to the spread doing? What is the close to the close doing? What is the intention behind this bar? And what are kind of analog bars this bar has? And some of you are going to say like, okay, well, maybe I don't understand everything here. Don't worry. We'll cover it next week. But I want you to be challenged a little bit. I want you to think, because usually when you're challenged, then your response, your mental response, is to kind of like overcome this challenge, and you need to think about this and figure things out. So I want you to be a little bit in that state, trying to figure things out, at least for now, at least for the next class. I want you to come to the next class and to say, I'm confused about this. This would be a good state for us, to be in to start this work. Swing analysis. So here you just look at the swings, right? So you could look at the downswings and compare them from, let's say, the price action from the result point of view and from the volume point of view, effort. Do that. Then I also want you to think about the behavioral analysis. What do different types of market participants are doing on that specific bar, on the specific swing? What about the CO? What about the institutional trend followers' hands? What about the professionals? What about the public? So just do it to the best of your abilities, to the best understanding that you have right now. And then I want you to think about the final deductions. What is the bias based on your analysis, short-term and long-term? And obviously, as we go initially here, you know the bias. After this, we're going to start revealing what's going to happen next. And that's going to be, a much more challenging task on its own. I also want you to think about the character, with which, let's say, the price will move up or down. But we will come back to this a little bit later on, so don't worry about that either. Okay, so let's go through the homework again. I'm just gonna eliminate right away so that this wouldn't confuse you. Just a second, guys. Okay. So what do we do for the homework? There is an optional homework on Apple that we have. This is the homework on price structural analysis. This is just continuation of the work that we've been doing so far with all of the homeworks. I'm giving you trading ranges, and now I'm giving you the volume signature here, so now you can use that. And you have to go and label Wyckoff events, Wyckoff phases, changes of character. There are quite a few trading ranges. So why is it optional? It's going to require a lot of time for some of you. And we've done the price structural homework, so therefore I want you to start doing volume homework. This is more of the priority right now, but if you do have time, please, go through this homework as well. The main homework is going to be on the VSA, right? So we said that we want to visualize all of the concepts from the slides 31 and 32. These are the concepts of the spread and the volume relationship. So we want to practice finding these scenarios on the chart and understanding exactly what happens, within that context. So you have to just print those out,
print out some kind of chart, let's say of like Apple, and just find all of those examples. So that's homework number one. And then homework number two is going to be on this group exercise that we're going to start next week. And here, I just want you to do your analysis, and to do your analysis in combination with the volume analysis. All right, guys, any questions, any comments? And today, again, we are finishing a little bit early because I have a medical appointment, so I have to go. But let me see if you have any questions or comments at this point. And thank you for bearing with me with my voice today. I'm just, something is going on. All right, so I guess no. All right, no worries, no worries. Okay, thank you for your wishes, guys. Just my voice. Yeah, thank you. All right, guys, I'll see you next week. Don't forget that next Tuesday, we're gonna have the Wyckoff study group. So John's gonna conduct the second session. Um, and I'm gonna send you the webinar link for that session on Monday. By the way, for those of you who have missed the first session, I've uploaded that session on the class homepage, under the session number 3 videos and the slides, so you could find that. So you definitely, are welcome to check this out. All right, guys, until next week, happy trading. Thank you, and bye-bye.